Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, I am going to be talking about Berkshire Hathaway selling a massive 50% stake of their stake that they had in Apple stock that was reported during their earnings report over the weekend. So this is Monday after the weekend. I've had a chance to listen to other commentators share the reasonings that they think Buffett might have done this. After watching and reading a lot of them, I noticed one really important reason that was absent from every single one. I really don't think I read it anywhere. I'm sure on the internet somebody has mentioned this, but I think this reason is underreported, and it's important. I think it's important for investors because if you kind of care what Warren Buffett thinks, which I think you should, if you can figure it out, then you can. I do think there's things that you can learn and that should at least influence potentially your investments, because Warren's the best investor alive basically right now. So let's first go through some of the reasons why Warren might have sold all this Apple stock. Now, they had sold some previously to the annual meeting. I did make a video after the annual meeting where I talked about some of this. And so he did answer a few questions about Apple stock. He basically said, relatively, it might not be too big of a tax hit because taxes could be higher in the future. They're relatively low right now. I think this was a little bit more of a justification of why he wouldn't let the tax implications prevent him from taking profits in Apple, rather than like a positive reason why he would take profits in Apple. So that's some minor distinction, but I do think it's actually important. That isn't actually one of the reasons. The tax reasons isn't one of the reasons necessarily that I'm going to talk about. I guess I do have that on my list, so we'll get that one out of the way. It's pretty rare for him to make like a big tax call. Now, he does try to minimize taxes, which most investors do. But what's interesting is he's not really minimizing taxes unless he's making a very bold call that corporate taxes are going up in the future. I think really what he's saying is corporate taxes are going up in the future. So, if they double or something, then, you could only sell half as much Apple in the future at the same price as you sell it now and to pay the same amount of tax. So, yeah, it just doesn't seem like a positive reason. And he could sell other things besides Apple, and they have other businesses in their portfolio where the tax situation could change, and he's not selling those, right? Except for Bank of America, maybe. So I don't think taxes are the main reason. The other reason is valuation. So that's why I have the Fast Graph up here. I do have 25% off affiliate link for Fast Graphs down in the description. It can be useful for looking at things like this. So here's the thing about the valuation. I actually sold Apple back here when it was the PE was about 26 and revenue growth and earnings growth were basically flat. And I had made a 500% profit on Apple because I bought it before Warren did. I think Warren now is making about a 500% profit too, but he's selling up here. But here's the thing. Once we got past the COVID stimulus boom, Apple's been trading basically in between a 30 and 22 PE. So we'll call it 25 to 30 PE. And it still is in the 25. I mean, he didn't just sell it all at this little peak here. He was selling through this. So he's selling the same valuation range on an earnings basis that the stock's been at the past 3 years, actually more like the past 5 years. But we had COVID, which was weird. So, but definitely the past 3 years, he could have sold Apple any time during that time. And most things were the same during that time, right? So you want to ask yourself, what changed from this peak when Apple was at 30 PE at the end of 2021 to this time period over the past like 6 9 months, right? And it's not a small sell in Apple. I mean, we're talking billions and billions of dollars. So I don't think valuation. Now, if Apple was super duper cheap, then probably he wouldn't sell it. Fair enough, right? The valuation is high. And I've been saying, I like Apple. I'm recording this on an Apple computer. I have all kinds of Apple products. But the stock price relative to actual earnings growth and revenue growth, which is not above inflation, basically, if we exclude the stimulus year here, isn't enough to support a 30 PE. So the stock is very expensive, but it was very expensive back here, right? So valuation to me doesn't make sense. I saw another headline. I didn't read the article. I think it was Domadorian who said concentration. It was either that or Josh Brown or somebody over on CNBC. I was sifting through some of the articles because I was going to show one on here, but I couldn't find one that looked good or what. They were all like either behind a paywall or whatever. But anyway, concentration is worth talking about. I did hear a couple people on Bloomberg bring up the fact that Apple was like 40% of Buffett's public portfolio, but the public portfolio is just a small portion of Berkshire, and he doesn't think about Apple as a stock that's part of a public portfolio. He thinks of it as one of the business that he has a partial ownership position in. So I'm not sure what Apple was relative to Berkshire as a whole, but it wasn't 40% of Berkshire. It was just a bigger portion of the stock portfolio. Warren has never been a person, and neither was Charlie, that would shy away from having a concentrated position in the portfolio if it was a good business or whatever. And so I don't think concentration is the real reason. Also, Apple was a very concentrated part of their portfolio 2 years ago. So again, from 2021 to now, that really hasn't changed very much. Another reason that I heard was that is it a recession call? Like he sees a recession coming and he wants to raise cash. They already had about 20% of Berkshire in like Berkshire's market cap in cash. I think now it's going to be like 30%. It's $277 billion in cash. I don't know exactly what Berkshire's market cap is. I think it's around 900 billion. So that's about 30%. Warren has really shied away from making recession calls. He didn't make a recession call in 2000 that I know of. Now he wasn't buying into like the hype and everything, but he never said, oh, a recession's coming and that's why I'm not buying anything, right? Same thing for 2006, 2007. He never made a recession call that I remember. The only time I can think he really made a recession call to some degree was back in like 1968 when he I think he even closed like the original partnership of Berkshire or whatever it was called then. I know he'd purchased Berkshire, but he basically gave people their money back. It was like, I can't find any place to put this money because everything's so expensive. So that wasn't necessarily a recession call, but it was, there's no place to put this money. And then it turned out to be one of the worst stock market periods from like 68 or 69 to 82 or so. Ever, pretty much, other than the Great Depression. So I guess maybe you could call that a recession call. You can't find places to put money, but selling something that you own and paying taxes on it is not usually something that Warren has done, rather than just not being able to find a place to put cash, the dividends and stuff that roll in, or you're selling on for valuation purposes, whatever. It's not usually like a big recession call. So I really don't think that's the main, reason. Another reason we're thinking about is he's kind of clearing the decks, so that when he retires, the new managers can have a clean slate pretty much with all the cash for them to allocate that they need, and that they can fully take responsibility for Berkshire going forward. Buffett kind of led it to this point, going to leave them with 1/3 cash and a bunch of great businesses. And there might be something to that. I mean, that is something that's changed, I think, in the past 3 years. Warren's 3 or 4 years older. Charlie's gone now. Warren did look pretty tired at the last meeting, and just his attitude was kind of waning a little bit in some of the things that he said in terms of his energy and things like that. So there could be something to that, I think. But the one issue that nobody mentioned that I think absolutely has to be mentioned, and I've talked about this on the channel more than one. No, I've talked about it 2 or 3 times, but I made one full video about China and why I'm not invested in Chinese stocks. I was, but after the invasion of Ukraine and China's response and basically tacit support of Russia's geopolitical decisions, along with their internal decisions in terms of the ability of public investors in public stocks to be able to actually make money in China, and for big public businesses to make money for investors in China, it just really isn't investable because the risks are too high. And we've seen Warren take action on that pretty clearly. They've sold, I think, most of their BYD stock, which had been a long time holding that had done very well, and a business that's still expanding around the globe. So that was almost certainly China risk. He bought and quickly sold Taiwan Semiconductor stock, very clearly based on geopolitical risk, and he moved that money to Japan. And what you've seen is, and I've warned investors about this, and this isn't like bashing China. I'm just talking about from an investor standpoint to the risks that are involved with your capital and your investments, right? So if you look across the earnings reports, every time I hear one come across on Bloomberg that has exposure to China, they're saying business in China, if it's an American company, Starbucks, McDonald's, Apple, Estee Lauder, I mean, there's more. But if they had significant exposure to China, it's been very weak there. And you can see that whatever's going on, some of it's just probably economic weakness in China, but again, that's part of the geopolitical risk. Apple sells a lot. Oh, Tesla was one I didn't mention. That's another one. So Apple sells a lot of Apple products in China, but they also manufacture a great majority of their products in China. And so that's a huge, huge risk for China. So it seems more in line from what Warren's been doing with his portfolio and the way he's been speaking. I mean, if the meeting at one point he's like, well, if you're watching what's happening going on around the world at one point, so it's very conscious in his mind. This is the person who was alive during the Great Depression, during World War II, was adult for pretty much all of the Cold War, and very much in the Washington, D.C. scene. And so he knows a lot about how these things go down and how they work. This goes beyond, that's just the wisdom of having lived through all this and been part of it. And then on top of that, obviously he has businesses that operate in every aspect of the economy almost. So, and friends who know everything about pretty much everything that's going on. So I think it's wise to take his lead, but you have to pay attention and see what one of the factors might be that nobody's talking about. And so for investors, I mean, to me, it means, look, you have to be really careful about the exposure that your businesses, that your stocks have to China. Starbucks, Tesla, Nike, I didn't mention them earlier, another one. If these American brands have a significant portion of their earnings coming from China, and the valuations are very high, which almost all of these were before they lost they're coming down, Apple hasn't really come down yet. They managed to like avoid it yet. But I mean, let's just look at some of them. Nike, look at this. Boom. And it was recovering, and then the invasion happens, and then now it's down 43%, right? And remember, the market's been at all-time highs until just recently. Let's see if I can get Starbucks to load. Maybe if I... Okay, so, and again, we have the peak during COVID, we have a recovery happening, and then invasion, and down 30%, right? Estee Lauder, they have a lot of exposure to China. Already now these were very expensive. I made videos on all these, so you can watch them, and I can talk about the valuations. But you see a similar pattern, peaks here, starts to come back, invasion, tank. Let's see. Tesla. Again, exact same pattern, right? Pretty much. We have a bigger sell-off here coming off the bubble. Starts to recover. This one recovers a little bit deeper because Elon, has X to kind of promote things. And then we get another sell-off and we get another little bump, but it's coming back down, right? As the actual kind of, and just look at look at the earnings, right? Lower. Last 2 years, earnings are falling. I don't know. I'm sure there's more that I'm not thinking of, and that aren't on the top. But pretty much every time I hear something, it's China business is weak, right? And it could be tariff pressures. It could be general global economic problems. But we have to think that behind the scenes, pressures being put on American profits. And, it's not like Chinese companies are doing great, right? So we can look at Baba. Earnings peaked in 2021. Now they're lower, right? This is if and I used to own these. I haven't looked at the earnings for a while because I decided not to buy Chinese stocks anymore. But look, Baidu earned $9.79 back in 2017, and they've only increased that to $10.70. They haven't been able to make they haven't been able to grow earnings at all for, like 7 or 8 years. And the stock price is just toast. So this is my message. There could be other factors involved in Warren selling Apple. I think the number one reason is China risk, both for their manufacturing and for their sales and just general geopolitical risk. So if you want to discuss that in the comments, drop a comment, tell me what you think. I'd be happy to discuss it all down there. The main thing, my main takeaway would be, look at your portfolio, look at the businesses that have a big business in China, especially selling in China. I don't know if the manufacturing risk is quite so big unless something really crazy happens geopolitically, which isn't my base case right now. So I feel like I'm kind of in the middle on this, but it just seems very clear to me that this is a big risk. And investors would probably be wise to reduce that risk. Now, as always, this isn't investment advice. This is just what I've actually done. And to try to kind of limit that risk. And I think Warren had a significant role in helping me recognize some of that risk. So it's worth tying it, I think, to kind of what he's been doing. But yeah, discuss it in the comments. I'll reply to all the comments, and let me know what you think. Later.